Good day, everyone. Les here from BG Trading. Hope you are well. Today is March 12th, Sunday, 2023. And the reason I put this video together on Sunday is because through the weekend, through the last 3 days, actually, a lot of people have been asking us, some VIP members, some non-members, just people asking us our thoughts about the collapse of Silicon Valley Bank. And so I decided to actually put together an analysis for you and for some of for members of our free Facebook community, which I'm going to be putting the details below. So have access to this analysis and understand exactly what's happening with Silicon Valley bank collapse. What is the effects? So I'm going to quickly and easily help you to understand, first of all, who is Silicon Valley Bank, and then we're going to go through the collapse and understand a little bit how the banking system works. Also talk about liquidity and insolvency, the difference, and how it has been affecting the banking system. And also finally, some latest prediction about interest rates and future Fed monetary policy. So we might see some light at the end of the tunnel, happening a little bit quicker than we ideally has anticipated, that the market has anticipated in the last month, where things start to degrading as inflation is still sticking around. So let's have a look. I just want to remind you, this isn't financial advice. It's just us from BG Trading sharing with you how we buy and sell stocks using BGS20 and BG Trading strategy. In this particular video, we're going to be talking about our thoughts on how Silicon Valley collapse will affect the market, as just said before. So let's understand first. What really happened and who is Silicon Valley Bank. So the Silicon Valley Bank is a bank that has been around for over 40 years and is once has been among the 20 biggest banks in the US, and pretty much fund by a lot of fintech businesses in the US. And unfortunately, in this latest financial report, the company has nearly $2 billion US dollar loss reported. And that was not the major problem, but the major problem was that in the same week, there was another bank filing for bankruptcy, and that subsequently, the fact that Silicon Valley Bank has also applied for capital raising and didn't actually done this successfully, and then that's when everything started falling apart. So the recent loss was primarily due to the company investing in a 3.5 years duration assets that with very low yield of securities, about 1.79, such as bonds, mortgages, and other assets inside, and high interest rates have had directly impact the value of these assets. And once the value of these assets started depreciating, the company at the same time having problems with liquidity, they have to sort of start selling the assets. And the moment they start sort of selling the assets, they have massive losses because the assets no longer worth what was before. In this case, the company reported about $1.8 billion loss after tax, which is a very it's huge, pretty much. The portfolio they trying to sell was $21 billion US portfolio, and they forced it to take a loss because it's the only way for the bank to have a short-term liquidity. So, but then the situation is start to degrade because the bank attempts to raise capital via institutional investors and other means of trying to raise $1.3 billion capital in that, but it was in the same week that another bank has just failed, and that triggered sort of really issues with its clients, and like really massive names like PayPal telling all the subsidiaries to withdraw money out of the bank right quickly, just as a precaution, and that problem has become a disaster for the Silicon Valley Bank, because what was once a problem for liquidity and could have been solved with capital raising became immediate insolvency situation, and that's when the bank had to be closed. So how the bank system works? Banks are a place where we can keep our money safe while we are paying bills, transferring money to friends, borrowing monies if necessary. But when we deposit the money in a bank, what they do basically, they get the money they deposit and they lend for all sort of people, businesses with a high interest rate. So that's how they pretty much make money. They also make investments and they leverage their capital by investing in just assets as I just mentioned before. And if those assets start coming down in value by all sort of macroeconomic situations. In this case, was for the direct increase of interest rates by Fed as a monetary policy. Then the bank starts struggle with liquidity. Nonetheless, things don't always go to the plan. In this case, what happened was the bank didn't have immediate liquidity. But if you're going to look into overall bank system, as you can see here, this is pretty much what are the sort of assets and liability chart from the cash assets and deposits. As you can see here, by just before the GFC, there was a very only 5% that the banks would be only 5% capable to pay off if everyone sort of withdraw the money. But then obviously the cash reserves increased quite a lot with quantitative easing after the GFC, and that's what pretty much what Fed started printing money, and then obviously when everything was really stable by around 2015, so then Fed starts sort of increasing rates again. Then we have COVID here, right here in 2019, 2020, and that's when they start pumping money into the economy again in order to boost and get financial lockdowns and all these sort of things. You know the story. And now with the hike of interest rates, things are coming down again. So the cash deposits are decreasing, and that's what causing problems like this to happen. And we might even see other banks in the same case. Most likely now Silicon Valley Bank will be sold to a big bank. We don't know exactly what's going to happen, but they are trying to sell now the whole bank to someone. So the shares fell really drastically in the last two trading sessions until going trading out. So I was worth about $260 US dollars a share by Wednesday. Then all of a sudden, after the announcement that the stocks just start plummeting 60% and then 60% again. So basically closing around $82 before going to trading out. And then obviously the company now is unable to, it's not even operating, the bank is not even operating at the moment. Now, Silicon Valley Bank failure has highlighted the importance of understanding the risks of illiquidity and insolvency in the bank system. That's why if things start, if the cash reserves start coming down too much because monetary policy are too tight, and that's what inevitably start to happening. However, what this major event has suggested that that this collapse could have been caused a major impact on Federal Reserve future decisions. So the Federal Reserve, the Fed, could soon even start sort of pumping liquidity back into the system. When I mean soon, I mean like maybe early 2024, and that will be most likely decreasing rates because they have rapidly increased the interest rates. We haven't actually seen this problem in Australia yet, but in Australia, the reflect will be in the mortgages. People like ourselves that have investment properties or families that have properties that will start sort of default. But in this case, in US, because the effects of interest rates are not as direct tied to mortgages as it is in Australia, you have directly reflect in the bank system. And then what suggests here, if you look at the trade, investors started speculating by July 2024, the interest rates in US will be coming down to 4.5 from 5, from its peak 5, which is probably in the next few months. So that could be positive in one aspect, that everyone is sort of expecting the worst now, but now could be the turnaround in the next couple of months if the Fed really take in consideration that more banks and companies will start going under because low liquidity in the system. Then I think we could see turnaround, and the Fed could start sort of injecting liquidity again via quantitative easing, or even obviously bringing the rates low again. Start slowly, but start bringing the interest rates low again. So, but that's not until end of the year or early 2024. Obviously, still inflation figures are extremely important, but the fact is now the Fed also have to give enough time for the economy to digest those multiple interest rates. The same thing I said to Reserve Bank of Australia. So if they keep pushing too hard, we will see maybe a mini collapse on the housing market here in Australia, and potentially collapse in more banks systems, more banks in the US. My view from this is that based on this speculation, the investors are already looking to lower rates by mid of 2024 on the future markets. So that could be the thing. We could see Federal Reserve change its policy and improving that on the side of sort of decreasing interest rates sooner than we actually are expecting. If that happens, then we might have not just a rally on a tech and growth stocks, but we could see other sectors such as property or retail stocks as well start sort of picking up. And I'm not talking about the real estate market. I'm talking about listed property, real estate companies, trust, Stockland, and many others. So so just keep in mind in this. So we gotta really look into closely, and obviously hope for no further banks to collapse. This is the first event since GFC, and we want to make sure we are also protected in some way. So I wouldn't be fully invested now, but I would be start positioning and look closely what's going to happen with the next interest rates hike, because that will dictate how hard the Fed is going to keep tightening the monetary policies. Guys, thank you very much. Hope that makes sense. If you haven't understand anything, or if you disagree with anything I said in the video, please put it in the comments below. I'm more than happy to discuss that. And and I'll see you in the next video this week. Have a great rest of the weekend. The whole idea when we designed BG Trading BGS 20 strategy was to use only a set number of indicators to make it simple and clear to understand, and to be able to apply our KPIs very easily and very effectively. So you don't have to be any Wall Street smart person to be able to apply those strategies. We really hope this course will help you to make better decisions and make successful trades. See you in the course.